Hey guys, hope you are all having an amazing weekend. We are about to begin yet another week in this current bearish market, and I am making this video with the intention of collecting and sharing with you guys all the facts about what is going on so that we can better anticipate and predict with a higher probability of success what is most likely to happen. We have some big quarterly earnings reports from big companies which will impact whether major indexes will retest support walls built last week or whether we continue our trajectory upwards into higher territory. I will also talk about recessions, because I find it more likely than not that if we are to have one, it will happen this year. As I said, a recession will bring about the market crash, which is in my opinion, one of the catalysts more likely to bring us MOASS and send us rocketing to the moon. I have said and will continue to say that what is happening right now in the markets is not the beginning of a crash. This is just a small correction before more upward movement, and that a market crash will also bring the housing market crashing down after imploding the bubble it currently finds itself. However, months from now, things are not looking very good with the yields, and we could easily find ourselves in bad economic territory. I want to give some insight into this on this video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. Investors aren't panicking, and no better example of this exists than the recent 2 weeks where we have seen retail traders come in and panic buy all types of stocks at the current low prices. The Fed announced this last Wednesday that it would begin lifting rates soon as a way to combat the sharp rise in prices we have seen. Fed Chair Jerome Powell confirmed the Fed is looking at March as the month to first introduce the first hike, while simultaneously declining to rule out that they would rise a larger half point instead of a quarter point. Bond investors are confident in their investments, remaining strong amidst current market conditions. This week it will be a bit of a wild ride. Monday kicks of a pivotal week in earnings season, with more than 100 companies in the S&P 500 set to report the fourth quarter earnings. Of all these companies, investors are fiercely looking at Amazon, Facebook and Alphabet, 3 of the 5 biggest corporations that account for 25% of the benchmark's total market capitalization. Amazon is already down 15.5% year to date as of Friday, and depending on the balance sheet, whatever they have to show could make or break the market, as investors are currently reassessing valuations of tech companies. Facebook, or Meta, is going to be evaluated in its recent virtual reality progress, and how many people they have brought in. Alphabet is expected to show adjusted earnings per share, already down 8% year to date. Investors will look at the momentum it has had on its cloud platform. These are only some of the companies that will have their earnings reports, but they are by far the biggest, and as such, will have the biggest impact on trading sessions this week. A less than already adjusted expectations could easily transition stocks back to testing support, but solid or even bullish earnings could have the market strengthen a rally. Aside from the earnings report, markets are also going to have to bear the brunt of employment data, which will have big spotlights this week. The Department of Labor's monthly job report is due to release on Friday, and everyone will have a look at the updated data that reflects the strengths of hiring and labor force participation. Economists expect employers to have added 150,000 jobs in January, which is lower than last month. Unemployment rate is expected to remain unchanged from December, which was at 3.9%. There's a lot of anxiety going into this week, and I believe we are in the middle of the turmoil. I think if the earning reports aren't bad, we will definitely consolidate and move upwards as the week progresses. If the reports are bad, we are likely to retest the lows of last week. The trading volatility will not bring danger to investors for long though, as sentiment is still strong since the reports do show the overall economy is making big improvements overall. Always remember that prices are linked to the economy and in part reflect investors' expectations for growth. With America already showing it's making strides to go back to where we were pre-pandemic, I find it way more likely for investors to continue to remain bullish about the market, which will bring everything up long term. For this week, asset prices will reflect the impression and first reaction to earnings and economic job reports. After we have these numbers in, we'll finally start to ease on the volatility and start progressing higher. Now, a lot of requests have been made for me to talk about the squeeze, with many asking me to talk about where we are likely to go and how long until we get there and when to sell. I must once again be the bad guy here and tell you that it is impossible to predict exactly when the squeeze will happen, because it is something likely to occur based on hedge fund or bank performance. They can delay and kick the can over and over because the system is built in such a way where they can continue to hide positions, increment their shorts, and pass on the hot potato per se between each other so that they can come off as clean when they get their audit. When a stock squeezes, especially given the economic circumstances we find ourselves in, there are many changing variables that will impact the squeeze price. If we would have squeezed last week, it would be a very different number than if we squeezed next month. So for me to come to you and tell you to be ready to sell at $500 or $1,000 would be incredibly dishonest. We don't even have the data to suggest how many shorts there are. Because of this, you need to readjust your mindset and expectations. The longer we wait, the higher the squeeze is, because more and more people are buying and holding the stocks, which means they have to cover more. What I want to give you guys today is some information regarding the Fed and the rate hikes. I have been talking about this for months now, but I feel like I need to smooth this out for you guys, because I strongly believe that if the economy is to have a recession, it is most likely to happen this year. Inflation is something you can't hide from. You can run as much as you want, but it will catch up to you eventually. Core personal consumption expenditure deflator rose 4.9% for the month of December. All we are talking these days is that the Fed is ready to raise interest rates again, most likely in March. I said in a video last week that the main problem Jerome Powell brought about to the markets, which is why they fell in the manner they did, was because of how hawkish he sounded. The more he talked, the worse things got because we got to really see just how concerned he is and how much control the Fed has last. He didn't even dismiss the possibility of a half-point rate increase. The markets bounced up on Friday, and many started singing praise. Indeed, as I have been saying since December, the markets were going to get their correction and continue moving up, because bouncing was and is always going to happen. However, as we continue moving forward, I think now more than ever, this will be the last rally of the markets. It could last weeks and even months in my opinion, but the music is coming to a screeching halt. The intensity by which we saw investors sell implied that there is another drop coming and they all know it. They want to ensure their survival by having cash during the next drop because cash is king on a bear market, and that is what we need to talk about. The clock is counting down to a recession and it will be the end of the bull market we have enjoyed for years now. The only graph you need to look at right now is the yield curve. Ben Levison put up a great article also talking about this, which I will borrow some quotes from. The clock term we use to refer to the end of times is the yield curve, and an inverted yield curve is a very reliable indicator for recession signals. An inversion occurs when long-term rates move below their short-end counterparts. This has two main effects I need you to know, so pay attention. The first effect is that it immediately signals a recession is impending, and you can verify this by looking at a historical chart. The other more important effect is that it actually fosters the economic conditions that will actually create and worsen the recession. This happens because it creates conditions in which lending becomes unprofitable for banks, which borrow short and lend long. The lack of credit causes a recession, and it only takes months for all this to occur. The yield curve is currently flattening, and it's doing so very, very quickly. Check this out. This past Friday, the 2-year Treasury yield closed at 1.17%, and the 10-year Treasury yield closed at 1.779%, which puts the difference between them at 0.61 of a percentage point. On December 31st of last year, the gap was 0.069 points. Recessions, historically speaking, come around 8 to 19 months after the yield curve invests, which positions the next one sometime this year through the middle of 2024 next year. My take when bringing the topic back to the rate hikes is that Powell is that he is hyper-focused on raising rates to tackle inflation because he has become desperate. However, the problem will really hit us all in the face when the Fed gets ready to lift rates aggressively and finds that the economy is actually not growing as much as they would like it to be. The pace at which they think we are recovering from is completely wrong, and as Omicron and whatever variant is next to emerge pressure us down, will only compound Jerome's miscalculation. The issue also lies with how late Jerome is to the party, which I have said before. He wants to raise rates but it's too late because it's late cycle. The Fed will literally tighten the economy right into a recession. I have said it over and over, this whole thing was and is still going to take some time, but it's undeniable and unavoidable at this point. Inflation grew out of control because the Fed wanted to protect the interests of Wall Street, and all the problems that were slowly growing in America. All the economic imbalances and unregulated Wall Street making bets they couldn't make good on all compounded to such a magnitude that they didn't just caused, but ensured that we would fall in the ugly and historic manner we are about to experience. I hope in the recovery process we can finally criminalize and throw all bankers in jail and rebuild a new financial market, because Wall Street is beyond saving or repair at this point. No amount of oversight or regulation will cure the cancer which they are to society. This recession, because of the implications it has, could very well be the end of the dollar as well, but that is a subject I don't think many of you care or are interested in, so I will skip though it. We might drive Lambos, but the country and the world in general are set of a reset that will force millions into poverty for the rest of their lives. It's going to get ugly, so park your money where you think is best, and for the love of tendies, come join my Discord already. We are talking about this type of thing there in more detail, and my Discord is open to everyone, so hurry up and join already. I wanted to make a video about where I think GME and AMC are headed, but volatility in this market makes it impossible to tell with any certainty where we are likely to bounce or break out. A single bad earnings by say Amazon will crush any technical analysis done, so pray Daddy Bezos's lovechild has good reports, or at least losses that aren't so bad, which I think will be the case. I am bullish for the week, to be honest, and we will get out of this correction celebrating only to a couple months down the line watch it all plummet while collecting Lambos and driving on the moon. I hope to see you all tomorrow in the recap video. If you want to support this channel, links are below for PayPal and Cash App for one-time donations, and my Patreon is there if you really want to spoil me. Enjoy the rest of your day and to the moon.